The commercial real estate industry is no doubt facing debt maturity issues, but it's important to consider the diverse range of assets, types, locations, and debt structures that might be impacted. As we've discussed on this channel all the time, office properties are going to be affected due to the challenges posed by hybrid work models and decreasing occupancy rates. Utilization of the office space has become a key underwriting element for office properties, and lack of utilization can make it difficult for new lenders to be comfortable making a loan. I mean, it makes a ton of sense, right? No tenants, no cash flow, no NOI, no loan. Urban core office buildings, so think downtown, are more likely to face trouble than suburban ones. However, buildings and markets with newer, amenity-rich and boutique-like properties are flourishing. Now, if you haven't heard the office market described as there's the best and then there's the rest, let me introduce you to that now, because you will hear it a lot. And what that basically means is that there's the best office properties, which are fully occupied and getting above market rents. And then there's basically everything else. And that is where the trouble lies. Now, multifamily properties, which have been a really popular asset class among investors due to renter demand, could also experience problems with maturing debt. So in the past, bullish multifamily investors used floating rate debt to purchase the properties at really low cap rates with the aim of fixing them up and then leasing them at higher rental rates. Like, that is the value add model. However, with this debt market, that model is now broken, leaving some property owners stuck. Multifamily owners with bridge loans are also likely to face challenges, as many of these loans are nearing maturity and require financing that's going to be really difficult to get. Now, certain types of loans may be vulnerable to debt maturity challenges, more so than others. So maturing bridge loans, which we just talked about, and then commercial mortgage-backed securities loans are frequently mentioned as the most problematic. So CMBS loans are particularly relevant in the office segment, as many of these loans are held in commercial mortgage-backed securities. While debt maturity issues are a concern for the commercial real estate industry as a whole, it really is important to consider the specific factors that may impact different asset types, like locations, the debt structure. The activity we're going to see in the market will likely be driven by assets with really shaky debt structures. So floating rate structures are simply coming due within the next 12 months. It's properties that have fixed rate loans, and owners that have these properties with fixed rate loans are likely to just hold tight through this market cycle. So we're not going to see people like refinancing out of a low fixed rate loan anytime soon. They're probably just going to hold the properties longer than they normally would. Now, if you found this update helpful, please subscribe below. And to be notified when new updates come through, that subscription will help. And if you'd like to have a weekly summary of the top news in this space, subscribe to the newsletter at thelimitedpartner.com/news. We'll see you next time.